Welcome back, Strongman Personal Finance. We got round 2 of our reaction to Investing Simplified Professor G's. If I had to choose just one investment forever, this would be it. So Professor G here, Mr. Grifto King, is partnering with all the clowns on YouTube to build his popularity, to build his money, because he doesn't care what you learn from his channel. He doesn't care what actions you make. He doesn't care if you blow up your freaking portfolio listening to what happens to Chris Zane. No. All this svelte, pretty-haired, probably takes it in the what, you know what. This guy just wants to pump his money, and that's all that matters. So let's continue and see who else he's partnering with, and let's see what they have to say. I'm sure they're geniuses. Oh boy, we're gonna watch this at 1.5 speed because I do what I want.
This next segment is going to be by a man who needs no introduction, especially if you've been watching my videos for any period of time. This is the best in the business on dividends, and his name is Ryne Williams. He consistently puts out the best information on dividends on his channel and has so many resources to help you earn passive income for life. I'm excited to see what he has to say here.
So first off,
okay, first of all, dividends are not passive income, okay? It's not even income. Well, it's taxes income, but it's not income. It's moving money from the company's balance sheet into your pocket. That's right. They're just transferring money. Go transfer money from your checking and savings account and then pay tax on top of that. That's a freaking dividend, okay? And the only reason he thinks Ryan, whatever his freaking name is, Ryan Dividend, the only reason he likes Ryan here, this guy looks like crap, by the way. He does not look good. He looks worn out and haggard, like he's like jaundiced or something. He's yellow. But the only reason he's shilling Ryan is because he's got a big YouTube channel. So let's see what old dividend genius with no formal education, hasn't took a lick of accounting, a lick of finance, no tax prep, nothing. Let's see what this bearded, balding genius has to say.
I want to give a big thanks to the Professor G for including me in this video. I am so stoked to talk to you guys today about dividend investing, which
this is going to grow my channel. Oh my God, I'm going to get so much more money pumping trash.
In my opinion, is hands down the best and easiest way to create passive income. One of the main reasons I personally choose to only invest in dividend-paying stocks is because the dividend payments are not impacted by the random whims of the stock market. In other words, no matter what the share price is doing, whether it's going up or it's going down, you're still going to receive your dividend payment. Now, as we
that is 150,000% wrong. Dividends come from earnings. Companies generate positive cash flow. They got money just sitting on the balance sheet. What do we do with this money? And they can either buy back shares, they can pay a dividend, or they can reinvest it, or whatever. Or just whatever they want to freaking do with it, okay? Here's the problem. If a company starts to deteriorate, their financials start to deteriorate, well, they desperately, try to keep paying the dividend because they know dividend investors are clowns. But if a company deteriorates, the financials deteriorate to a point where they can't afford to pay a dividend, they need to keep the cash on the balance sheet, guess what happens? Your dividend can be cut. It doesn't just always come. And if we're in a bear market, that means corporate profits are being smashed. And if they have to, companies will cut their dividend. And I actually agree, they should. He's totally wrong.
We all know share prices can fluctuate pretty dramatically, and it's not uncommon for that to happen as a result of things that aren't really related to the company's actual financial performance. Certain news
a lot of the times it actually is.
Can come out and a company's share price can either plummet or soar just based on whatever that news is. Dividends, however, are always rooted in the company's actual operations and its ability to generate profits and free cash flow.
False. Companies can borrow money to pay dividends. You got to know how to read the financial statement. Just because you're getting a dividend, and half the time it's not even a freaking dividend. Look at Yield Max. It doesn't mean that it's always just based on the fundamentals. They could be borrowing money to pay a dividend to sustain it.
If a company isn't growing and if it's not profitable and generating free cash flow, then it will not be able to sustainably pay and grow its dividend. So in a way, at least this is how.
That's true, but I thought the dividends were all the time. What if we're in a recession and free cash flow isn't growing?
I think about it, it kind of forces you to invest in fundamentally strong companies, and those are the kind that you should want to own anyway. On top of that, dividend investing is incredibly straightforward, and it's
no, the market determines the value of the company based on future expectations. A company may look bad now and may soar in vertical line in the future. Okay? You shouldn't exclude a company because it doesn't pay a freaking dividend.
A very low stress, low maintenance way to invest, okay? You just buy the stocks, hold on to them, and collect the income. That's literally all it takes. And since it's naturally a buy.
Is that easy, bro?
and hold strategy, you don't have to worry as much about trying to time the market. And this is very important, you don't have to sell your shares down the road to be able to benefit from the investment, which is something that you just can't say for non-dividend paying stocks. And honestly, that's
Well, yeah, I guess that's true. You don't have to sell the shares, but you're paying freaking tax every year on the dividends. Whereas if I don't sell my shares, I can defer the tax far into the future.
something I've never fully understood about the non-dividend payers. Why would I want to own something where the only way to get any sort of benefit out of it is by selling it? I mean, that type of investing works just fine for a lot of people, and there's certainly more than one way to do things, but that thought has just never sat well with me. Why would I want to?
Okay, but the idea they just transfer cash to you, that's better. Even though the company's price drops by the amount of the dividend. Yeah, why would you sell a stock that went up 10,000%? Why would you own Berkshire Hathaway? Oh my God, what a stupid company.
To work so hard and spend decade after decade after decade building up my portfolio, building up my collection of assets to only have to sell it off down the road. With dividend paying stocks, I can have this cash-based relationship with my investments where they just give me a paycheck for being a shareholder. Depending on the business, that paycheck
Yes, from the cash on the balance sheet, the company's value drops by the amount of the dividend.
could keep coming even after I'm no longer here. And now we're talking multi-generational wealth, which is awesome. Now, having said all
Oh, because I can't own VT and, own the entire world, and that can't be passed on.
that, dividend investing certainly has received criticism over the years. Many people say that, instead of paying out a dividend, a company would be better off reinvesting in the business for more growth or buying back shares. And there is some truth to this.
It depends. It all depends.
Some companies can probably generate higher returns on their capital reinvesting it instead of paying it out as a dividend. That's true, but there are a lot of companies out there where the best use of it for shareholders is to pay it out as a dividend. And this is another key point about dividends. They can help hold the management team accountable. If a company were to retain all of its earnings, there'd be pressure on the management team to find ways to invest that capital, even if there aren't great opportunities out there to do so. And the reason for this is because they just, need to stay busy, I guess. The management team is being paid a lot of money, and so one way they can justify being paid as much as they are is by staying active. And for them, any activity looks better than no activity. But the risk that comes along with
What the heck? I don't even understand what he's saying here. So how does this justify them paying a dividend?
the need to keep up that appearance is that it can lead to bad capital allocation decisions, like, for example, bad acquisitions, which ultimately is going to do more harm than good for the company.
Then why are you invested in that company?
By committing to paying a dividend, management has less capital to work with, which, once again, could be a good thing or a bad thing depending on the company, but it does force them to be more strategic and selective in how they allocate capital. In other words, having less capital to work with helps make sure that what they do have is put to better use. And
Basically what I do is whenever I get a paycheck, I immediately take cash out of the bank. I wipe it with my butt. I wipe my butt with cash, and then I flush it down the toilet. And that makes me more disciplined with my money because I got rid of some cash. That's right.
that is something Warren Buffett has talked about quite a bit. In his 1989 shareholder letter, he refers to what he calls the institutional imperative, which essentially describes a situation in which companies tend to follow certain decision-making patterns, often resulting in bad outcomes. As he puts it, just as work expands to fill available time, corporate projects or acquisitions will materialize to soak up available funds.
Yeah, grifters will materialize to soak up retail dopes funds.
And like I said, that can lead to bad uses of capital and ultimately poor returns for shareholders. But anyway, guys, in a nutshell, dividend investing is a very simple, very straightforward way to invest and create passive income. This type
Hey, let me tell you a secret. VT pays a dividend.
of strategy allows you to focus on building long-term wealth without having to someday sell off your assets down the road. Like I said earlier, all you need to do is buy the stocks, just hold on to them and collect that income, and then repeat.
The next gentleman on this list is going to be
Ryne is such a clown. I hate that guy. They're all grifters. Don't you see it now? No, they're not. He's only partnering with Chris Sane and some crypto clown. He's a good guy.
going over the exact opposite as far as style for investing, but still investing in individual company stock. These are going to be the fun and exciting stocks that can definitely boost your portfolio to the moon very, very quickly. Tom Nash has an awesome YouTube
That's not true.
channel where he talks a lot about growth stocks and just overall investing, so definitely go check
Yeah, and if he loses money in a stock, he deletes the frickin' video.
that out.
Folks, I believe that long-term investing creates generational wealth. And I've said it multiple times before, one of the best investments any individual investor can make is the S&P 500. But I also believe that you can spice up your S&P 500 holding and add some generational winners to that portfolio to make it even...
Who says they're generational winners? They could be generational losers. You don't know the future. You think it's I'm just going to pick this stock. It's easy, bro. Just buy the good stocks, bro. Oh, okay, just buy QQQ. Just shut your mouth. Just buy QQQ. Why are you buying SPY? Just buy QQQ, bro.
better than 10% per year. Now, I'm not arguing to go against the S&P 500. That thing is undefeated. It's a juggernaut. But all I'm saying is you put a portion of your portfolio in winners and individual stocks that will be around in 10 years.
Actually, the S&P had a flat decade from 2000 to 2010.
dominating their industry. That investment can take your portfolio from 10% a year to a whole new stratosphere. Now, the way you do it is, first of all, by not gambling, by understanding it's all about long-term horizon, and by studying some important skills like how to evaluate companies, how to identify such long-term generational winners, and by understanding that time is the best friend of a great business, which means that
Ooh, I've got the secret sauce, guys. Check out my Patreon.
sometimes prices in the short term of great companies might be volatile, might be down because of market sentiment, because of psychology, because of manipulation, whatever it may be. But long term, if you stay long enough, the same way you do with the S&P 500, long term, if you have selected great generational companies, those companies will defeat the short-term market sentiment. Now,
If you just pick the best companies, you'll beat the market, bro. It's that. Just pick the best companies. It's easy. Look at my studio. I got multiple monitors because I'm a good investor, bro. Look at that. The more monitors, if you have 20,000 monitors, you're a good investor, bro. The more monitors, the better. Where's a picture of Putin, Tom? Huh?
my point here is very simple. Focus on the S&P 500. Make sure at least 40 to 50% of your portfolio is in a large index fund. And the other half, make sure you select wisely. Because selecting
No, not half of your portfolio. You're not good at selecting. I don't care if you bought a stock and it went up over the short term. In the long run, if half of your portfolio you're picking growth stonks, at some point, it could be 10 years down the road, you're gonna get clapped. And that's the beauty of the index. You never get totally clapped. Yeah, indexes can go down, but you're broadly diversified and you're riding efficient markets to glory.
a stock for the next 20 years is pretty much like marriage. You don't just marry anybody. You want to marry the love of your life. The same thing with stocks. Find your own stock
Love doesn't exist, Tom.
that you believe will be dominant on the next 10 years. Find a couple, 2, 3. Don't go overboard with selecting 20 stocks. You probably should max that at 5 tops.
So you 5 stocks and the rest in S&P 5. So you're highly concentrated in America and not even the whole American market. Just screw small caps. They didn't go up a lot. And then on top of that, you got to massively concentrate your portfolio in 5 companies. Half of your wealth, half of my money ain't going into individual stocks. No, don't do it. One day you will blow up your portfolio, high IQ geniuses. And guess what? You'll just buy the dip and then it'll vertical line again.
Make the research, understand the valuations, and make the long-term commitment to dollar cost average into these companies. If you dollar cost average and you actually DCA, dollar cost average double on weakness, and you do that over the course of the next 10 years,
Then that's not dollar cost averaging if you're double D. That's not double. What are you talking about? DCA, it's very simple. You do your budget. I make this. Here's my expenses. This is how much I have left over to invest for my long-term goals. And that's what goes in every time you get a paycheck. That's it. You're not double DCAing. That's timing. That's not DCAing. You're timing the market to buy the dip.
assuming you've selected good companies, the market is going to reward you with some incredible results, a lot better than just the 10% you can get out of the S&P 500.
False. Well, here's what happens. You pick good stocks, talk about it all the time. You pick bad stocks, delete the video.
Now, of course, you're going to have some bad years, you're going to have some great years, but when you look at this portfolio in hindsight, when you zoom out and you look 10 years into the past, you're going to see how great the market treated you. Because
Or you're going to look back and say, wow, I got blown the F up.
you understood one little principle. Time in the market is way more important than timing the market. Stay in the market, focus on the large index fund, and focus on finding 2, 3, 4, maximum 5 generational winners to spice up your portfolio and dollar cost average into the afterlife.
So now back to me. For number
Oh my God. I don't even know what to say. Let's see what Numbnuts has to say here.
6. And if you're a part of my channel, you know exactly what I'm going to talk about, but I'm going to give you some new information here today. This style of investing is usually what pretty much all investors at least have a little bit of their portfolio in. For me, it makes up the vast majority of my portfolio, and I'll tell you why. When looking at the S&P 500 versus fun stocks like Nvidia or Palantir, or looking at dividend type stocks,
If you're buying a stock because it's fun, you're crazy. You're insane. Investing is easy. It's easy to do, but it's not easy to keep doing. The hard part about index investing is clowns like this pretending like they're geniuses, and you feel like you're not beating them. And it's all an illusion. It's all fake. It's all nonsense.
or even REITs with all those fun little cash flows. S&P 500 is quite boring. It generally goes up about 10% per year, but it's not going to be the investment that makes you
False. That's past performance is not indicative of future performance. This is the most low IQ argument I hear all the time. Does not matter what happened in the past. Things can change in the future. What?
You triple your money in 1 year. What I love about ETFs or index fund investing the most is that it gives me what I believe is actually more valuable than money, and that's time. I get to invest in something that's going to beat inflation and grow like crazy long term with compound interest, but also that I don't need to spend hours of
Compound interest. Yeah, because stocks pay interest.
my day researching. If you invest in individual stocks, you have to stay up on the company and the CEO and the competitive advantage and even the competitors themselves in the industry. The stock could go down 40% in 1 day if you're not up to speed on it. ETFs stay relatively stable, especially if you stick to broad ETFs like VU.
Yeah, go look at the Great Financial Crisis. Go look at the Great Depression. You know, ETFs can go down a lot, okay? And you bussies will sell, I promise. And I will just be chilling. Watch, we need a trial. We need a cleanse of the market. The degeneracy must be cleansed. I can't wait to see indexes collapse 50%. We have a multi-year bear market. Oh, please bring it to us. Please give it to us. I need this. And guess what I'm going to do? What I'm always doing, because I actually understand what I'm doing. You're just buying stuff that goes up a lot.
For the S&P 500 or VTI for the total US stock market. And ETFs are
Where's VT, loser? Huh? It didn't go up a lot.
Index funds do all the work for you. When an individual company does really well, the fund is probably going to pull that up and have more exposure to it within the actual fund. Just like how Nvidia has grown like crazy over the last year, and because of that, because its market cap has grown, it has a much larger piece within the S&P 500. And so now, since I was investing in the S&P 500 all along, now I'm invested in Nvidia and at a pretty high percentage. And vice versa, if a company's doing pretty terrible quarter after quarter, after a little bit, the fund itself kicks those bad companies out, so now it's not dragging down your portfolio anymore. I didn't have to research to figure out which ones I need to kick out, and I didn't have to deal with any taxes because it got kicked out.
Yeah, you let the market sort it out. Oh, so I can maybe buy, I don't know, a world index where the market sorts it out? Really?
That's just what happens because the ETF does the work for me. ETFs are considered to be low-risk investments because they're low cost and hold a...
False. 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 If you buy a ETF, even the SPY can go down a lot. It's possible. Okay? It ain't low risk. The new definition of low risk is like, it keeps being shifted. The Overton window keeps getting shifted for risk. Now high risk is like buying Bitcoin on leverage. Buying Bitcoin is lowish risk. And buying SPY is no risk. It just goes up. It just goes up, bro. 45-degree angle forever.
A basket of stocks or other securities, increasing diversification. In addition, ETFs
Alibaba. Oh, what does he got here? Big tech. Big tech and Alibaba. I love it.
tend to have much lower expense ratios compared to actively managed funds, can be more tax efficient, and offer the option to
He's like, U.S. stocks, bro. And then, of course, he has Alibaba in there. I love it.
immediately reinvest dividends. One ETF can give investors exposure to many stocks from a particular industry, investment category, country, or a broad market index. ETFs can also provide exposure to asset classes other than equities, including bonds, currencies, and commodities. My 3 ETF portfolio is the best way I've found for
Oh my God. Oh my God, I hate this. I don't like this guy. He's a grifter. And if you can't see who he's partnering with, you still think he's legitimate, you're smoking something very green and it's making your eyes bloodshot. Oh, you're so you're in space, bro.
for any investor to invest in, and it's what literally over 95% of my equities portfolio is invested in. It keeps things very simple, has gained an average of over 13% per year over the past 10 years every single year, and I have more time.
What? Every single year it just goes up 13%? Every year? Stocks just go up at a 45-degree angle?
Time and peace in my life to be able to spend that time doing things that I want with my friends and family, which is much more important than looking up anything in the
I hope you don't have any friends and family. You're a degenerate. You're scum.
finance realm. I've linked to each of the creators' channels down in my description below. Watch this video to learn more about that simple 3 ETF portfolio that's taking over the
3 ETFs. That's really simple, bro.
world, or watch this video to keep you going strong in your investing journey.
Jesus, what a freaking loser, okay? So, once again, he's pumping real estate investing. Just buy houses, so easy, bro. Options trading, total degeneracy. Bitcoin, fundamentally worthless garbage. Dividends, an accounting gimmick. And growth stonks, because vertical lines, U.S. stocks, bro. And then 3 ETFs that went up a lot that you buy because they went up a lot. What a freaking moron, okay? Once again, the degeneracy continues. Professor G is a con man. All his little grifting buddies are losers. And if you listen to him, in the long run, I'm telling you, he doesn't care about your future. He's not pumping good advice. No, he wants money. And it's okay to have money. Want money? But you want to do it legitimately. Not by deception. Not by fraud. He presents himself as a financial expert. He is not a financial expert. But he's got certificates on the walls, and that means he's smart. Anyway, hope you enjoyed the video. Like, subscribe, check out the pinned comment below. If you want a sponsored video, I'll do sponsored videos. Pay me $50. I'll do a video about whatever you want. Check out my book, Stop Being a Broke Loser. It's on Amazon. You'll stop being a broke loser the second you buy it. You become a billionaire. And if you want to talk to me, you want to have one-on-one accounting chat or just talk about anything, see the pinned comment below. I don't do stock price valuations. I'm not going to manage your freaking portfolio, but if you just want to pick my brain about why I do what I do, you can talk to me, but it's going to cost you. Talk to you later. Cheers.